Hello everyone, and welcome back to Explain the Charts. Today is November 21st, 2025, and we are taking a close look at Microsoft, symbol Microsoft. The stock has been under significant pressure this week, caught in a broader tech sell-off fueled by some serious questions about AI valuations. In this video, we'll first unpack the critical news driving this sentiment, and then we will dive deep into the charts to see what the price action is telling us about what could happen next. Let's begin with the news that has been dominating the headlines. The most significant catalyst for the recent weakness appears to be a rare analyst downgrade from Rothschild & Co. Redburn. They've argued that investors are miscalculating the economics of the generative AI boom, stating the massive capital expenditure required will not generate the cloud-like returns the market expects. The analysts specifically noted the high cost and short lifespan of AI chips, suggesting some projects could even become value-destructive for chip owners. This perspective suggests that while growth may be strong, the returns on that investment are being overestimated, leading them to state it is no longer a bull case. This sentiment has been echoed across the market, with Forbes citing new levels of AI anxiety following recent big tech earnings reports. We're seeing a classic case of profit-taking and valuation jitters as investors weigh the long-term promise of AI against the immediate, colossal costs. This has directly impacted Microsoft, which saw its stock fall nearly 3% yesterday, closing at $478.43. This isn't the only headwind either. Older reports from September highlighted potential new tariffs on semiconductors, which could further increase costs for Microsoft's data center infrastructure. However, it's not all bearish news. An analyst recently reiterated a bullish stance following Microsoft's expanded $30 billion partnership with AI startup Anthropic, arguing the company's story is much more than just generative AI. Furthermore, a valuation narrative from Picacoder puts a fair value on the stock at $500, suggesting it is currently undervalued based on ambitious growth projections. So we have a clear battleground: bearish concerns over AI profitability versus a bullish belief in Microsoft's long-term growth and diversification. Now, let's turn to the charts and see how this conflict is playing out in the price. Looking at the daily chart, we get the big picture story of Microsoft over the past year and a half. The stock was in a powerful, sustained uptrend for the majority of the period. We can see the price climbed from a 52-week low of $344.79 back in early April. That rally culminated in an all-time high of $555.45 on July 31st. However, look closely at that July 31st candle. The stock gapped up to its high and then sold off aggressively throughout the day, closing down nearly 4% in a massive bearish reversal candle. That day marked a major turning point and the beginning of increased volatility. After that peak, the price entered a period of correction, eventually finding a bottom in the low $500s through August and September. The market then attempted another major rally in October, pushing the price back up towards the highs. On October 28th, the stock hit a high of $553.72, just shy of the all-time high. This created a potential double-top pattern, which is a classic bearish reversal signal. The failure to make a new high showed that buying momentum was exhausted. Since that late October peak, the trend has clearly reversed to the downside. The recent break below the $500 psychological level has accelerated the selling, bringing us to where we are today. This price action directly correlates with the negative news cycle about AI costs we just discussed. Let's zoom in on the last 3 months to better analyze this reversal. Here we can clearly see the second peak in late October failing to surpass the July high. Notice the sharp increase in selling volume on October 30th and 31st as the price broke down from the $540s. After a brief attempt to stabilize, the critical psychological and technical support level at $500 was breached decisively around November 13th. A break of such a key level often leads to accelerated selling, which is exactly what we have witnessed. The volume over the past 3 days has been significantly elevated, especially on November 18th and 20th. This high volume on down days confirms that institutions are likely selling, and there is strong conviction behind this bearish move. The price is currently hovering just above a potential support zone around $475 to $480, which acted as resistance back in June before the big summer rally. Now, switching to the 1-hour chart, we can see the short-term trend in greater detail. Since the break of $510 last week, the price has been in a clear and aggressive downtrend. We can draw a channel of consistent lower highs and lower lows. Each attempt to bounce has been met with selling pressure at a lower level than before. For example, the bounce on November 12th was rejected right at the $511 level. The subsequent bounce attempt on November 14th failed at a lower high of $511.60 before the next leg down. The breakdown over the past 48 hours has been relentless, with very little buying pressure stepping in. From a short-term perspective, any counter-trend rally will likely face immediate resistance near the $490 level, which was the last area of consolidation before this most recent plunge. Finally, let's drill down to the 15-minute chart to analyze the price action from the last 2 days. On November 19th, the stock tried to stabilize around the $490 level, but ultimately failed, closing near the lows. Yesterday, November 20th, we saw a gap down at the open, and sellers were in control for the entire session. Notice the pattern of sharp drops followed by weak, sideways consolidations. These are known as bear flags and indicate a strong likelihood of trend continuation to the downside. Every minor bounce attempt was sold into, pushing the stock to a new low for the move at $475.50 in the final hour of trading. For traders watching the intraday action today, yesterday's low at $475.50 is the most critical short-term level. A break and hold below that level would signal that the next leg down has begun. On the upside, buyers would need to reclaim the $485 area, a zone of heavy selling from yesterday afternoon, to show any sign of a potential reversal. All right, let's recap the key takeaways and look ahead. The narrative is currently dominated by bearish concerns over AI profitability, and the chart is reflecting this with a clear short-term downtrend. Our key resistance levels to watch are, first, the intraday level of $485. Above that, we have a major resistance zone between $495 and the psychological $500 mark. It would take a powerful move to reclaim $500 and suggest the bears are losing control. On the downside, our immediate support is yesterday's low around $475.50. If that level breaks, the next major support zone isn't until the $450 to $460 area, which was the consolidation range back in early July. So, let's outline the potential scenarios. The bearish case seems more probable in the immediate short term, with about a 70% likelihood. This would involve a break of $475, confirmed by high volume, targeting the $450 to $460 zone. The current news cycle and technical momentum strongly support this outlook. The bullish case, which I'd place at a 30% probability for the next week, requires buyers to defend the $475 level aggressively. We would need to see a strong bounce that reclaims $485 and then challenges the $495 resistance. This would likely require a positive catalyst, either a shift in broader market sentiment or company-specific news that eases the AI capex fears. Long-term investors may see this pullback as an opportunity, but the short-term path of least resistance appears to be lower. In summary, keep a close watch on that $475 support level, as it will likely dictate the next major move for Microsoft. Thank you for joining us for this analysis on Explain the Charts. If you found this breakdown helpful, please hit the like button, comment with your thoughts, and subscribe for more in-depth chart analysis. And now for our disclaimer. This video is for educational and informational purposes only and should not be considered financial advice. Trading and investing involve risk, and you should always conduct your own research before making any financial decisions.